Okay, we are back and we're still continuing with our introduction. So FXQuintillionaires. Now the last time on the third video what we did was how to buy and how to not how to buy but how you make money when you buy and how you make money when you sell. Then now what we're gonna focus on, we're gonna continue from that and then we're gonna do terminology now this time. Okay, so I want us to continue where we left off. Okay, so now here's it. I'm just gonna draw a chart. So now what that thing meant is, let me see if I can get it here. Okay, so okay, it's no more here. Okay, so what happens is, from the chart that we were drawing, we were showing how to make money when you buy, you will then conclude that we said if you are buying, you will make money when the chart is going up. Remember your seesaw, things had to go up in order for you to make money. But if you buy and then things go down, then you lose. And then if you are selling, then if you can go back to that video, you will see if you are selling, you will make money if things are going down. But should things go up when you click the button sell, then you will lose money. You want them to go down. So it's the same thing now on the chart now. So if you are buying, you will want to buy here because the chart is gonna go up, then you're gonna make money. And then if it turns, then now you will wanna exit that position. So what we do is, in trading you use the term buy to enter a position. So you buy, you are entering a position. Now when you want to exit that position, you simply click the button exit or close depending on the app that you will be using. So when you exit, then you are out of that position. Then if you anticipate things to fall, then you can click sell again after clicking exit. Then when you're selling, remember you make money when things are going down. So then if should it continue down, then you'll be making money, and then you'll make money as it goes down. If it turns again, you see that now it wants to go up. Since you know that if things are going up, if you sell you lose money, then what do? You exit that sell position. So you exit it. Now if you see that things are going up, what do? You buy again, because then now you know we're going up, and then you take advantage of that price. Then should you buy and then thing continue going down, then you lose money. Should you sell and then thing continues going up, you lose money. So yeah, we're still gonna go into strategies. How do you know when things are gonna fall, and how do you know when things are gonna continue going up? So but what I want us to do on this video is, I want us to look at some terminologies what we use here on Forex. Okay, so what happens is, as you can see here on this table right here, if your price is going up, we buy, and if your price is going down, we sell. But then again, if things are going up, usually we say this is a bull market, or we say things are bullish. So it can be bull or bullish. And then here when they are going down, the opposite of that is bear. So here they are bearish. It's either it's bear or it's bearish. So now you can say it's a bull market. Then once you say it's a bull market, we know it's going up. If you say it's a bear market, we know you're saying it's going down. Or you can say it's long. You say, like, you can say I went long on GU, then we know that you bought GU. Or you can say I went short on EG, then we know you sold EG. Or it's a short market or it's a long market. So once you say it's a long market, it means things are going up. Once you say it's a short market, it means things are going down. And then we come to the spread. Okay, I simplified things here. The way I've explained things is just a too simplified version, but then from the notes that you're gonna get, then you'll be able to read the whole definition of what something is. But what I was writing, I'm the one who wrote this, and then what I did was just to simplify them to a point. Okay, so we have a spread. A spread is the money that is being charged by your broker. And then now you'll ask me, what is a broker? Then okay, we said on Forex we have banks, right? And then we have you who wants to buy $1, and then now you want to buy $1 from a bank. But then now what banks do is, like companies, remember we spoke of JSE and all that stuff. Yes, so what happens is you get a broker in between you, right here. You get a guy that you refer to as a broker. So what happens is, when you want to buy $1, you ask this guy how much is a dollar, then this guy goes and asks the bank how much is a dollar. So he just takes that question to a bank, then a dollar tells him okay, a bank tells him okay, a dollar is 10 rand. Now what this guy does is he comes back to you and then he adds now money that he will be charging you. Now he will tell you a dollar is 10 rand 50. So now that 50 cent, now that is what we refer to as a spread, because it's the money that goes to that intermediate guy. You don't deal with the bank directly, but you deal with this guy, and then this guy deals with the bank. Okay. And then another way of explaining this, how you see it on the chart, is if you have your chart, so if you have your chart like this, yeah, and then you'll see that we have two prices. We have an ask price and a bid price. So how this works is, an ask price is usually red, and then but then you can customize your own colors, and then you have a bid price which is blue. We are still on spread. So an ask price is a price, let me write here ask, and then I write here bid price. So an ask price, it's a buying price. That's your buying price. So if you want to buy something, they will be selling to you at this price that corresponds here with the ask price. And then a bid price, it's a selling price now. So if you are selling something, it means they will be buying it from you at this price that will be here. So if you had 1 2 3 4 5 6, it means now if you, let's say maybe this was a dollar and there's a, if you wanted to buy this pair, then they will sell it to you at 4 rand. You will have to buy it at 4 rand. But then now if you had a dollar on your in your position, and then you wanted to come and sell it to them, they will want to buy it to you at 3 rand. So then again, the difference between the two is referred to as spread again. So we're still on spread. Sorry, yeah, you'll get it from the note. So we're still on spread again. So we have an ask price and a bid price. An ask price is a buying price, and the bid price is a selling price. If you want to buy, they sell to you at that ask price. If you want to sell, they buy from you at that price that corresponds with the bid price. So that's how it is. Let's go back to another time and see what it says. Okay, we have margin. If you remember, margin is the money that you need in order for you to open a position. So if you remember, we were making examples here and saying $1. Okay, let's hope we still get it here. Okay, it's no more here, but you remember that we said $1 is equal to 10 rand initially, and then now you go and then you buy that dollar. So this 10 rand, that's the margin, because this 10 rand, it's actually the money you need to buy this dollar. So without this 10 rand, you cannot have this dollar. So then this is your margin. Then let's say now after buying this, let me go to a clean page. If let's say after buying that dollar for 10 rand, after buying that $1 for 10 rand, so you buy this one USD for 10 rand, but then now things start going down now on the chart. While we're expecting things to go up and then we make money, but then they go up all the way down to 0. Let's say they go to 1. So if they go to 1, so 1 USD now is equal to 1 rand. So it means now, since you have a dollar on your position that you bought with 10 rand, so it's like now when you are taking that dollar back, now you will be making 1 rand, because they're gonna buy it from you at 1 rand, because that's where the exchange is now. So if it goes all the way down to 0, once it gets to 0, it's like you are no more in a position. So if we explain that now in terms of margin, so the margin that you need to enter a position, once you go in a loss with some brokers, once you go in a loss of the, and then you get to a negative, which is the same amount as the margin. Now let's say you need a 10 rand, and then you go to minus 10, or you go to 0, or it goes negative until all that margin is used up, then they will kick you out of a trade. So meaning they will exit a trade for you automatically. Our next term is balance. I don't even know why I wrote that. Like, that's how much you have now on your broker. That's your balance, the money that you have. And then we get free margin. Now what free margin is, you remember when I was explaining margin, let's say you had a balance of $200 with your broker. Okay, let's say you had your broker. Okay, let me explain how this broker thing works first, and then I'm gonna explain that free margin. because I want to show you. Let me cut this off. Okay, cut. Okay, so now when you are trading, what you do is, we have a broker and then we have you. What you do is you open an account with a broker, any broker, and then you transfer money from your bank account. Let's say you're using ABSA, and then you're gonna transfer money from this account up to that broker's account. So let's say you transfer about 5,000 rands, which might be equal to $330. I'm just estimating this price, so it might be about $330. It will depend on the exchange rate. So then you have that money now with your broker. So when you are taking a trade, it's that money that is at risk. It's that money that is at risk, not this one here. Sorry, not the money that you have on your bank account, but it's that money on your broker. So it will depend on you how much you are risking on a certain pair. It's not like more when you're buying something or when you're selling something, you use up all this money. You can risk a little of it. It's 330. You can risk 5, you can risk $10, you can risk $20, you can risk $60. It's all up to you. If you want to make more money, obviously you'll have to risk a lot. And then after risking whatever you'll be risking from your balance, whatever profit you make will then come into and add there onto your balance, and then whatever loss you make will also come from that balance there. So then then we can then go back to our free margin. Remember that we said a margin, it's the money you need to open a position. So then a free margin, it's the money that is left from your account that you can still use to take some more positions. So that's a free margin. So if you had your balance of 330 and then you used $20 to open a position, if you wanted to open one position, let's say you're buying USD ZAR, and then when you're buying USD ZAR, and then now you'll be left with $310. So when you're left with $310, then that $310, it's the money that's remaining that you can still use to take some more positions. So then that's your free margin. That's what they mean by free margin. So let's look at another term. Another term is equity. Okay, so if you take positions and then you are running positions, so while those positions are running, you'll be able to see how much profit you are on or how much loss you are on at that time, even before you can close the position. As it goes up, you can see how much you're making, and as it goes down, you can see how much you're losing, depending on whether you bought or you sold. Now then equity, now it's always your balance plus that running or that active profit or loss that is that is actually running at the time. So that's your equity. It's just your balance. So it will be your 330 plus whatever that is running at the time. Then let's look at another. Okay, and then we have a pip and a risk or a lot. Okay, a pip. How I define a pip is simple. It's just the change of the fifth number on your price. So if you have these prices on the side of your chart, then if the fifth number changes, that is a pip. So then it will depend on how much they change. So if it changes by 2 times, then that means the price went up 2. So let's say our price started from this price. So we have 1, 2, 3, 4, 5. So if this number changes, that's a pip. So then now it went from here, let's say price was here, and then all of a sudden it goes to that number at the top. So it means this thing changed 5, it went to 6. You see we're at 45 now, 146. So that means this one changed by 1 pip. So from there it goes up again to this number right here. From 46 to 48. Again this number changes. This fifth number, say 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So again this one changed to 8, from 6 to 8. It means it moved by 2 pips. From here to there, you can see a move from 48 to 58. So you can tell that one was 10 pips. From here to there again, it went from 58 to 78. So you can tell a move from there to there was about 20 pips. And then it moved from 378 to 478. So a move from there to there was about 100 pips. So peace. We'll continue on the next video. Bye for now.